Alhamdulillahi Rabbil Alamin. Assalatu wassalamu ala Rasulillah. Guys, Assalamualaikum. Welcome back to our series here on Islamic Bank Risk Management. So we are looking at the market risk faced by Islamic banks, and our focus here will be at the profit rate risk. So before going into the theory and the cases to actually present the case for Islamic banking, let us just look at the development of events in Malaysia associated with interest rate risk. In 1983, the first Islamic bank in Malaysia, and that is Bank Islam, was set up. And most of the product offered by Bank Islam are debt finance, contracted under the BBA or Babit Thaman Ajil, and that is basically by Al-Inah. Plus, we have also the high purchase, Islamic high purchase, Islamic Ijaratul Al-Bay' or ITAB, and other finances, personal financing and business financing are also contracted under by Al-Inah. And Islamic Bank were operating alone until 1983, when the conventional bank offers the Islamic window services. Again, we can see that from 1993 to 1997, most of the product offered by Islamic banks, full-fledged Islamic bank, Bank Islam, as well as the other Islamic windows, were mainly fixed rate product. Right? There's no floating rate product offered by the Islamic bank. And when we have the Asian financial crisis in 1997, where interest rate has risen up to 15%, then we saw how the Islamic bank were badly hit for the lack of floating rate asset. So most of the asset held by banks are contracted under the fixed rate contract of Al-Inah and Ijaratul Al-Bay'. So when interest rate goes up to 15%, so we can see that the lack of floating rate option have badly affected the performance of Islamic bank, because they are not able to increase the profit rate of the BBAs or the by Al-Inah's product, due to the fact that this contract are based on one price, one contract principle, that once you have contracted the BBA based on the prevailing rate of, let's say, 3%, then the 3% will be locked into the profit margin and the ultimate selling price. So profit margin plus the facility amount will give us the selling price, which is the debt obligation or the debt created from the facility, and that price, the selling price, cannot be altered over the duration of the contract. So when we have the Asian financial crisis, so any of those products, that basically run over 30 years for property financing or 7 years for high purchase, you will see that the Islamic bank were not able to accommodate the rising interest rate. While the conventional bank, they are able to do so because their loan rate are adjustable. There is no issue regarding buy and sell in the conventional loan, because they are essentially based on money lending with interest, whereas the Islamic bank is driven by buy and sell, does the contract of sale specify only one price in one contract, and that have actually bring the Islamic bank into a straitjacket that they cannot really accommodate any kind of repricing of the asset. So this has essentially well documented in Bank Negara report in 1998, how badly affected were Islamic bank. And we can see that later on we can discuss that the Islamic bank faces what we call the profit rate risk and rate of return risk, displaced commercial risk, and all this ancillary risk. I will explain later on to provide some detail how the Islamic bank were in bad shape from the 1997 Asian financial crisis. The Islamic bank are not able to reprice the asset because doing so will make the contract invalid, and this will trigger Sharia non-compliant risk. Then we can see that effort were done in order to mitigate any kind of danger that can happen in the future. So between 1999 to 2001, Bank Negara introduced the floating rate product, and from there on we can see that most of the Islamic products are structured based on a floating rate system. So there is a ceiling rate as well as the effective profit rate, and the way how the product was structured to capture interest rate volatility was explained by the setting up of the ceiling rate versus the effective profit rate, which we can talk about later. So we can see that 2004, the Islamic banking subsidiary were set up, and we can see later on that in 2021, when the Feds raised interest rate to control inflation from 1% to 5%, and Bank Negara also were raising interest rate from 1% to 3%. So we can see that the interest rate hike were not badly affecting Islamic banking, because most of the assets have been structured based on a floating rate system, and so that risk mitigation effort spearheaded by Bank Negara through the Sharia Advisory Council have to some extent helped the Islamic bank to weather any interest rate volatility that can impair banking profits and capital. So how the Islamic bank were badly affected when they have no supply of floating rate asset, that we can explain later, and how the interest rate risk or the profit rate risk were mitigated through the introduction of the floating rate product by way of the ceiling rate system that I will explain as we go on into the discussion of profit rate risk in Islamic banking. Okay guys, I think that's it for today. I'll see you again in the next presentation. Assalamualaikum warahmatullahi wabarakatuh. Thank you very much.